Welcome to Atcons, the easiest way to explore your journey of investing in stock market. Stock market crash? What's in the mind? A stock market crash is a decline of stock prices across a major cross-section of a stock market, resulting in a loss of wealth. It's a panic selling due to economic factors. They frequently follow speculation and economic bubbles. A stock market crash is a social phenomenon where external economic events combine with crowd psychology in a positive feedback loop where selling by some market participants drives more market participants to sell. Crashes usually occur due to the following conditions: a prolonged period of rising stock prices, a bull market, and excessive economic optimism. A market where price earnings ratios exceed long term averages. Extensive use of margin debt and leverage by market participants. Aspects such as wars, large corporate hacks, changes in federal laws and regulations, and natural disasters within economically productive areas may also influence a significant decline in the stock market value of a wide range of stocks. There is no numerically specific definition of a stock market crash, but it commonly applies to declines of over 10% in a stock market index over a period of several days. Crashes are unexpected. As Niall Ferguson stated, before the crash, our world seems almost stationary, deceptively so, balanced at a set point. So that when the crash finally hits, as inevitably it will, everyone seems surprised and our brains keep telling us it's not time for a crash. So, what should investors do? Well, if you don't need your invested capital now or within 3 to 5 years, our advice is to hang on. Don't turn paper losses into real losses by selling low. We have seen new clients tell us that they have sold when the markets went down and bought again when they went up. Why? Well, they simply felt that this was the sensible thing to do. This is the classic way for investors to lose money, time after time. For example, if you had missed the best 25 days out of the 7,300 days between 1986 and 2006, your compound annual returns would be 6.72% instead of the 11.74% the market returned. Key considerations. The old adage of buy and hold is very true. If you do not need the money, our advice is to hang on. Action point. Perhaps inaction is a better way of putting it. Ride out the storm. If the volatility has really upset you, then reevaluate if you should be reducing your risk here. Or should you be in the stock market at all? How to make money in bear market. Everyone loves bull markets. In a bull market, every stock will give us good returns. But bear markets test one's real ability, companies' fundamentals, and investors' patience levels. But bear markets also provide wonderful investment opportunities if we are able to spot investment chances early. We can make good money in very short-term period. Accumulate more on every fall and invest for long term to reap full benefits. Even good stocks will be available at cheap prices in bear market due to bad sentiment. Alert! Operators will try to fool investors by artificially rising stock prices by spreading rumors. Be careful with small cap stocks. If you don't have enough knowledge of stock markets, stay away from these things. Investors can't sit idle in bear markets, as investors overreact to bad news and stocks will lose all the gains in 1 or 2 days. These ultra short-term opportunities are only for experienced investors who can spend enough time on stock market research and at trading terminal. More companies are planning to buy back shares means we are going to get investment chances to make quick money. I hope you liked the video. If you liked the video, don't forget to like and share. Keep practicing, keep learning, keep growing.